Have you ever stared at a stock chart, watched the price bounce around, and just had that feeling like you're missing a huge piece of the puzzle? Well, you probably are. You see, while most of us are glued to the price, the professionals are watching something else, something that tells a much deeper story. Today, we're going to pull back the curtain on that hidden half of the market, volume. And this right here is the fundamental idea that separates the pros from the amateurs. It's not about having a crystal ball to predict the future. It's about understanding what's happening right now with way more clarity. Price is only half the story, and trust me, the other half is where the real action is.
You know, watching the market with price alone is kind of like listening to a conversation with one ear plugged. Sure, you can hear the words, you know what's being said, but you miss the tone, you miss the emphasis, you miss the conviction. Volume? Well, that's the part that tells you how they really feel. Let's break that down. Price just gives you the facts. A stock went from 100 to 101. Okay, but how did it get there? Was that just a few small traders pushing it up, or was that a tidal wave of institutional buying? That difference is everything, and it's exactly what volume shows us. Here's another way to think about it. Every price move is basically an argument being made in the market. And volume? Volume is just a head count of how many people showed up to fight for that side. It's the measure of participation, of belief, of the real muscle behind any move. So, when we say volume, we're really just talking about a simple count. The raw number of shares changing hands over a day, an hour, whatever period you're looking at. And as we're about to see, this simple count is the key to unlocking the market's true intentions. All right. To make this idea really stick, let's step away from the charts for a minute. I want to use an analogy that I think we can all instantly understand. Okay, so check out scenario A. 100 people show up to protest. That's pretty low volume. The government, or in our world, the market, can easily just ignore them. The policy stays, the trend continues. But now look at scenario B. Whoa, 100,000 people show up? Now that is high volume. That is a force you absolutely cannot ignore. And it really is that simple. The size of the crowd, the volume, is what dictates the outcome. High volume is the market literally screaming its belief in a price move. Low volume? That's just background noise. Okay, so we get the why. Volume is conviction. Got it. Now for the how. How do we actually read this language? Well, professionals use a pretty simple framework that breaks down into 4 core signals. Think of this little table as your secret decoder ring. The top 2 rows are all about confirmation. When price and volume move together, price up, volume up, that's a strong bullish sign. It means the big institutions are on board. The bottom 2 rows, though, those are your warnings. If you see the price creeping up, but the volume is falling, that is a huge red flag. It means our protest is losing steam and the smart money is quietly slipping out the back door. Now, if you only remember one thing from this whole explainer, please let it be this. This signal is so important. When you see a stock finally punch through a key price level, the excitement is real. But a professional trader's first question is always, okay, but where's the volume? See, a legitimate breakout needs a huge surge of participation. The general rule of thumb is that you want to see volume that's at least 1.5 times its recent average. If it's less than that, you're very likely looking at a false breakout, which is just a trap to suck in hopeful buyers right before the price slams back down. And the numbers on this are pretty stark. Something like 70% of breakouts that happen on low volume fail. And they fail fast, usually within just a few days. Ignoring the signal is probably one of the quickest ways to end up on the wrong side of a trade. So let's get practical. This isn't just theory. These signals pop up on charts every single day. They leave behind these really clear footprints of what the big institutions, the so-called smart money, are up to.
So let's start with a classic example of confirmation. Here we're looking at TCS. And for a long time, it was just stuck under this 3,400 resistance level. It was like a ceiling. It just couldn't break through, a very significant level.
So when it finally broke through that ceiling, just look at what happened to the volume. It didn't just tick up a little bit, it absolutely exploded. We're talking more than 3 times its average daily volume. This wasn't a whisper, it was a roar. This was our 100,000 person protest. And the result? The breakout held beautifully, leading to a nice 6.5% gain over the next 6 weeks. That massive surge in volume was the market telling us, hey, this is real. The big players are behind this move. The volume confirmed the price. Okay, now let's look at the flip side, a warning sign. Here's HDFC Bank.
On the surface, if you're only looking at price, everything looks great. The stock is pushing to new highs, a lot of retail traders are probably getting excited and jumping in. But the professionals were watching a very different story unfold. You see, as the price was grinding higher, the trading volume was steadily drying up. This is a classic pattern called a bearish divergence. It means the trend was basically running on fumes. Fewer and fewer people were willing to buy at these higher prices. And sure enough, the trend just couldn't sustain itself. The stock rolled over and ended up correcting by 12%. That falling volume was a clear early warning sign that the institutional support, the fuel for the uptrend, had simply vanished. So, we've seen how volume tells a story over days and weeks, but we can actually go even deeper. We can decode the institutional story happening inside of a single trading day. Now, this is a bit more of an advanced technique, but it's incredibly powerful. It's a technique called volume spread analysis, or VSA for short, and you can think of it like being a detective. For any single day on the chart, you're looking for 3 specific clues: the total volume, the price spread, that's just the range from the day's high to its low, and finally the closing price. And from just those 3 clues, you can figure out what the big money was doing. For instance, if you see a day with super high volume, a really wide price range, and the stock closes right up near its high, that is a textbook signal of professional buying. They were absorbing all the selling and pushing with conviction. On the other hand, if you see high volume and a wide range, but it closes near the low for the day, that's professional selling. So, let's wrap it all up. Remember, price is the headline, but volume is the story. It reveals the conviction, it reveals the institutional footprints, and it reveals the true strength behind every single trend. So, now that you can see the market's other half, the only question left is, what will you look for first?